Dear guests, please take your seat now. The public lecture and discussion will begin in 5 minutes' time. As a gentle reminder, we ask that you kindly switch your mobile phones to silent mode. This session will be recorded for informational, educational, and marketing purposes. The recording will be hosted on YouTube and our website for your viewing. A write-up and related materials may be made available together with the recording. Do take note that the copyright of these materials shall belong to NTU. Welcome to the public lecture in the Dean's Distinguished Speaker Series. I am Izera, a second-year accountancy student in Nanyang Business School, and I'm honored to be your MC for tonight. It is wonderful to see all of you guys here in person, and for those of you tuning in from online all around the world, thank you for being part of the session today. In tonight's session, Mimicking Finance, we'll explore how AI and machine learning identify predictable patterns in financial decision-making, using Professor Lauren H. Cohen's framework to distinguish routine actions from departures from past behavior, and to examine how predictability, behavioral signals, and outcomes are linked, alongside considerations of responsible AI use. Also, a special thanks to everyone who submitted their questions in advance. The speaker and moderator will address as many as possible during the session. Now, it is my privilege to invite Professor Byung-Hyun Hwang, Division Head of Banking and Finance, for his opening remark. Professor Hwang, please.
Good evening, everyone. My name is Byung-Hyun Hwang from NBS, and it's a real pleasure to welcome you to this evening's Dean's Distinguished Speaker Series. We're very fortunate to have two outstanding individuals with us, our speaker, Professor Lauren Cohen, and Mr. Timothy Tay, who will lead the discussion and Q&A. Mr. Tay is the Head Chief Investment Officer for APAC Credit at UBS Global Wealth Management. He holds an MBA from the University of Chicago, where Lauren got his PhD, and a bachelor from NTU. And then maybe later this evening you can tell us which institution you think is better. Mr. Tay is a leading expert in global credit markets and investment strategies, and is also one of our most successful alumni. So we're truly delighted to welcome him back to campus this evening. So in just a moment, I will invite Mr. Tay to begin the session and formally introduce our speaker, Professor Lauren Cohen. But since I've known Lauren for almost 15 years, perhaps you'll allow me to also say a few words about him. So I met Lauren 15 years ago when I was in the market. And so academia can actually be extremely cutthroat, right? So you always want to be the first to discover something, or once you've found an area, you want to be the person tied to that field. So when I was a PhD student looking for a job, Lauren was already a star professor at Harvard. He had just written a seminal paper arguing that social ties, social networks are a key channel through which information diffuses in financial markets. So another PhD student and I, we had written a paper kind of also emphasizing the importance of social ties. It also just got published. Now, what a cutthroat academic would do is either pretend that our paper didn't exist or beat up on it, right? But not Lauren. What I later found out is that Lauren, I think also Andrea and Chris, what they ended up doing is they ended up sharing our paper with others, telling them how cool of a paper they thought it was. And they even used their Harvard connections to hook us up with magazines, newspapers. And you have no idea what that means to a PhD student. And he did this not just for us, but for dozens others. And by doing so, he's really empowered them to kind of create cool research. Right? So he's contributed to our field not just directly through his papers, but also indirectly by emboldening an entire generation of young scholars to produce research that ended up advancing our field. like in general, I think Lauren is one of the few people in our profession who, as a his personal life is almost as interesting as his papers. Like, it's a guy who wakes up every day at 4 a.m. to lift, and when he lifts, he deadlifts, squats like 250 kilograms. Like, most of us can barely do 50. And he qualified as a world's strongest man for the World's Strongest Man competition. Amazingly, so did his wife, Nicole. Right? And then after gripping and ripping it at the gym, they come home and get their 6 kids ready for school. It's just, it's a guy who has interesting things to say about almost anything. So I'm sure you're all eager to hear what he has to share today, so I don't want to delay this any further. So let me hand things over and invite you to please join me in welcoming Mr. Tay to the stage.
Thank you. I'm going to give you a series of numbers, which is very dear to my life, right? 9656 K7905. Right. This is not the password to my crypto account, not my social security number. This was my matriculation number in NTU in 1996, right? I do have a memory for such things. And, you know, my wife was my NTU as well. She doesn't remember anything. She doesn't remember a matriculation number. And why do I remember the matriculation number? Is it because I had wonderful professors? You know, I don't remember who they are, but the reason is because you had to write this number at every single exam in NTU. 4 times every semester for 3 years. And it was really painful, right? So, but anyways, one of the dreams that I have when I was undergrad here was that perhaps one day, even despite my mediocre academic background, right, perhaps I can come back to NTU and contribute in a way or another. So I'm very, very happy here today to see everyone here who's participating in this, and obviously professors, staff, students, as well as our distinguished guest speaker. So welcome to the Nanyang Business School Distinguished Speaker Series, and thanking all of you for joining us who come for this intellectually very stimulating session. And tonight's lecture is interesting because it sits at the intersection of finance, data, human behavior, 3 things that we all know can be perfectly rational in theory, but wildly unpredictable in practice. And that makes a very perfect moment to introduce our speaker, who is Prof. Lauren Cohen. And, you know, Professor Huang has done a great job at it. So I'm going to just keep it quick, right? So his work has been published in the very top academic journals and has influenced not only how academics think about the markets, but also how practitioners, regulators, policymakers understand real-world investing behavior. So in short, if markets have a pattern, Professor Cohen has probably tried to identify them, test them when necessary, politely tell us what he think was skill was actually something else. So tonight, Prof. Cohen will present his paper, Mimicking Finance. So without giving too much away, his research explains how investors copy one another and what might imitation look like, you know, and what might be intelligence and what might be not. So without further ado, Prof. Cohen, please, the mic's all yours.
Fantastic. Thank you so much. And look, I want to start by thanking, not only the wonderful NTU faculty and MBS faculty here, but the entire community for really welcoming me here to talk about this. And, this is very much something that I am excited to talk about. And I'm excited to talk about it because this is a conversation more than it's going to be a lecture. Okay, I'm going to spend a little time. I'm going to tell you my thinking in this area and what I've done to this point, but I'm really looking forward to getting your thoughts on this. And so I want to start really by thanking all of you for coming tonight and for everyone who's online. And I want to thank you because you get to take part, and you are taking part in really my favorite part of this. Look, this is why I got into this. So Byung talked about why, he got into this profession and what it's looked like. I'll tell you why I got into it. Okay, I'll tell you right from the beginning. The reason why I got into this profession is so that I could be a 4-year-old every day of my life. Look, I have a 4-year-old at home. And I can tell you, the best part about being a 4-year-old is every day you get to learn something new. And every time you see something, it's like a new puzzle that you get to solve. And so the fact that we get to do that over and over again is really the most wonderful part of academic communities. And I'm so excited to be 4-year-olds with all of you today. And we get to really take this puzzle, and this puzzle is something that the world is solving today, right? How these pattern recognition tools, and look, that's all AI is. AI is a pattern recognition tool, and it is one step on many steps that we've been taking literally for thousands of years, right? Human brains are wired for pattern recognition, and this is just another step in that direction. Statistics has been doing this. We've been doing this with early computing and then machine learning, and now AI is another step. And it says, hey, look, as we sit on this boundary, how is this going to change the world? And in what ways does it change it in some kind of manners that we should respond to? And I'm going to be looking at specifically in finance, but you'll see this has a lot more implications in general about the way we'll think about the world. And I want to start with this. And so this may be a little bit hard to see, this table, but the reason I want to start with this is because this is a study that was done by Microsoft and OpenAI. So it was their leading AI scientists. They did a study, and they did a very broad study to say, hey, look, AI's coming. Who's it going to impact the most? So they actually made a list of jobs. They said, here are the top 50 jobs that we think are going to be impacted the most by AI in the future. And so if you start to look through this list, right at the top of this list, probably not surprisingly, things like interpreters. Okay, yeah, pattern recognition. Turns out we think there's a finite lexicon of words in these languages. We can cross those. And so AI is kind of almost custom built to do things like interpretation, right? You look down, things like writers and some of these other things, telephone operators, kind of make sense. But as I went further down this list, one thing definitely stuck out to me, and I'm going to circle it here, because as you look down, what it says here is business school teachers, post-secondary, and economics teachers, okay? That's exactly me and many of you in this room. So I've got to say, I definitely started to get a little bit nervous, okay? The heat started to go up, Professor Cohen started to sweat a little bit, and even though that made me a little bit nervous, as I looked through the list, I actually cooled down a little bit, and I'll tell you why. Because as you look through this list, you're going to see a lot more on here, things like library science teachers, geographers, we don't need those anymore. Historians, you're gone. Political scientists, sorry, bud, better be polishing that CV. Mathematicians, turns out we don't need these anymore. And so as you look through, it started to look like a list a lot less like what was going to be displaced and more like the OpenAI team had some like vendetta about some classes that they didn't get an A in college, and so they're like, we're going to get back those mathematicians. And if you look a little bit closer, you know, as for our practitioners in the audience, they're also personal financial advisors. You have others, essentially exactly management analysts, data scientists. But my last hint toward this kind of college vendetta was models. So maybe there's somebody they asked out in college that said no. They're like, yeah, we're going to get you back with our AI list. Okay, we're playing the long game. And so this was their list about the most sensitive to AI. They also had a list about the least sensitive to AI. So these were the jobs they said, hey, look, even if AI comes, you're going to have your job. You don't have to worry. And so some will stick out here, but you can look and kind of pick out your favorite one. Top of that list, we have things like phlebotomists. Okay, it's going to be hard for AI to take your blood. Embalmers, that's one of my favorite ones, so they're totally safe. You have roofers, dishwashers. Bottom of the list, sea dredge operators. Okay, it's going to be very hard for AI to dredge the bottom of the sea. And so what's kind of interesting about these lists is when you look around, you see that these lists have a lot of pretty important differences in terms of the geographic age and educational disparities that they imply. Okay, and we're going to see part of that start to play out even within labor markets. Okay, and that's going to be important because that's going to affect not only how we think about this within the financial industry landscape, but within work more generally. Okay, so what can AI do and what can it do? Well, I'll start out with where it has really failed within financial markets up to this point. Okay, so first, And this was really one of the first applications, and I'm sure that Timothy can speak to this as well, and that is predicting markets. Okay? New tool comes along. What's the first thing we do as financial professionals? Well, any good financial professional will tell you, we try to use it to predict prices. Okay? Predict stock prices, predict real estate prices, predict fixed income prices, because if you can do that, then you don't end up being a billionaire, you're a trillionaire, if you can actually do it. And so this is something that these banks have been working on for really now probably 3 decades. Okay, they've been hiring computer scientists, they've been hiring physicists, mathematicians to try to use everything from early machine learning all up the way through AI. And it turns out, by and large, the answer to whether AI can predict markets is a pretty big no. Okay? So this was a paper that was published within Science, and what they essentially found is that markets are just too dynamic. Okay? They're too new. They rely too much on innovation. And so what AI is not great at all at predicting are truly innovative things. And those are the exact things that move markets. For instance, if I were to say, hey, look, you get to choose one thing, one factor that describes the most variation in the last 10 years of prices across markets. And you could choose your favorite market, the stock market, the bond market, real estate market, commodities, you name it. Turns out it's the same factor that does it. That one factor, the pandemic. Okay, that health shock. It turns out that displaced prices more than anything else in the world. And I will tell you this with some authority, there's not a single AI model, not a single machine learning model that in 2019 said, hey, I know what's going to happen. In 2020, there's going to be this global, unprecedented pandemic that's going to move prices in a certain way. That's exactly what AI missed. Okay? And in general, AI missed Fukushima. AI misses the big geopolitical events because, by definition, even those leaders, right, even Putin, Trump, Xi Jinping, you name them, they don't know how they're going to react. And so in that sense, no AI model can fit that. And so because those are the things that move prices, AI has no chance at predicting those. Okay? So I'll go on it a little bit, and I'll tell you what they are actually using AI for at these big banks. Okay? So I have a little bit of inside information on that. But it turns out, not great at predicting markets at all. Okay? In fact, they actually did this with money, and they used this ChatGPT, and they gave it $50,000, said, hey, look, we want you to take this money and create the best portfolio you can. And it turns out in the first month it made money, but after that, underperformed massively. Okay, and then they pulled the plug on it. Now, not only does it have trouble doing that type of thing, it also is not great at things like freelance work. So we recently ran a horse race between these different AI models and asked it to do freelance work. This is the percentage of tasks that it got correct. And so what you can see here is that these are on the order of about 2% of tasks that it can get right. Okay, so there are a lot of limitations into what these even frontier AI models can do. One other very basic one is that, and they're actually working on this now, and that's why I think this is so fascinating. I bet a number of you have washing machines at home and dryers, but not a single one of you has a folding machine. We can wash clothes and dry clothes, but not fold them. Okay? Folding, it turns out, is it's one of these tasks that is human intensive enough that we have not been able to figure out how to machinate it. Now, they are trying to, with AI, create folding machines, but they haven't been able to up this point. How are they doing it? Interestingly enough, they're actually strapping GoPros to people and then having them videotape them folding clothes and all the different ways you can fold shirts and pants and socks. And so they're trying to create these machines, haven't been able to do it yet. And so it's, again, one of these areas where it seems like such a simple task, mundane task, and yet AI does not help us with that. Okay? So now we have these mundane tasks that it has trouble with, along with truly innovative tasks. These are things that it really has a lot of trouble predicting. Now, they also put it to work and trying to predict some of these other tasks at work, and it turns out they can't even do things like close pop-up windows. Okay? Having to close a pop-up window perplexed even the most advanced AI model when it came up randomly. So what are these big banks using it for? Well, I was giving a keynote at another AI conference at Wharton recently, and they had in there the head of Goldman Sachs's AI. Okay? And so I said, oh, this is awesome. I'm going to get to see what Goldman invests. They have, tens of billions of dollars. Again, they've been doing this for 30 years. So I get to find out how they are using frontier AI and what they do. And here's how they're using it. Right now, the way that Goldman is using AI is a fancy indexer. It's a fancy EDGAR. So if you don't know what EDGAR is, it searches company documents, company annual statements. And so they have this proprietary version of a really fast index. That's what they're using it for, okay? Not to predict stocks, bonds, commodities. They're using it to just index words, index text, along with using it to write legal filings. Because it turns out, even though it can't predict markets, it can predict what the next IPO document should look like, because that document looks a lot like the IPO document before it and the IPO document before that, okay? These are the things that have been found to be repeatable. Okay, that are repeatable tasks AI can do. And so what we ask in this paper is, hey, are there other tasks like that that might be repeatable enough that we can start to use pattern recognition in markets in a powerful way that it does work? Okay? It can't predict tomorrow's prices based on time series of prices, yesterday's prices, but maybe it can predict behaviors. Because if there's one thing we know from behavioral economics and finance, it's that human behavior is quite predictable. So the way we do things, it turns out, from day to day is pretty similar. So I promise you, we can go around the room here and I can predict nearly everyone's toothpaste. Okay? How would I pick your toothpaste? Easy, because it's the same toothpaste you used yesterday. And it's the same toothpaste you used the week before that. And in fact, you're not going to change your toothpaste until they discontinue it. Okay? We all use the same toothpaste every day. We all we drive to work the same way. We put our yogurt in the same spot in the fridge. We do lots of things the same way. Those behaviors, it turns out, are incredibly ingrained. And those, we found in behavioral finance, change very rarely. And so we take that insight and we say, hey, look, if behaviors are something we can potentially predict, let's see if that applies to portfolio trading behavior too. These are behaviors of mutual fund managers we look at, and we say, can we learn from Timothy's past behaviors, look at all of Timothy's trades, and we say, gosh, over the last 10 years he's been a trader, every time the market has gone up, he's done this. He's made this change in his portfolio. Every time that a stock has gotten too large, he does this with it. Every time that something happens with one part of his portfolio, he reacts in the same way. And we say, can we use a model to learn all of that and maybe give some insight into Timothy's next trades? And here's what we find. Okay, and so there's one big key takeaway from that. The answer is yes. Okay? Yes, in a way that we were surprised by. So how much can we predict? That's the big question. And here's the answer. Using just Timothy's past behavior, on January 1st of 2026, I know that, Timothy thinks, God, I'm like an investing pirate. I'm going to look at what happens in the information. And I'm going to trade day by day. And I don't even know what I'm going to do. We'll see what happens in February, March. On January 1st of that year, we are able to predict over the next quarter 71% of his trades. 71% of the buy, hold, and sell decisions. So if he holds 100 stocks, which the average equity mutual fund manager holds, of those 100, we can predict 71 correctly whether he's going to buy more, whether he's going to sell, or whether he's going to hold. Okay? That's true across the universe of asset manager behavior over the last roughly 30 years. And so what does that mean? Well, that means that there's a fair amount of his behavior and mutual fund manager in general behavior that is predictable, that's mimicable by what they've done in the past. And I think the really interesting next question that brings up is, gosh, how should we then, as investors or as mutual fund managers, if I'm Fidelity or Vanguard or another big mutual fund family, how do I deal with that fact? If I know that 71% of what my manager is going to do next quarter, I can predict in advance. Should I pay them for that? Should I pay them the same amount for that 71% if I know what they're going to do anyway? Is there some way where I can incentivize them? That means that 29% is stuff I really can't predict. Do I care about the 29%? What if they're losing money on the 29% and they make money on the stuff I can mimic? I don't even need you anymore because the stuff you're going to make money on, I can already predict. So you can get out of town. I can put a closed sign up on the door, and I can just mimic what you're going to do. So we dig into a little bit more, and we find these performance implications. So what does this mean for performance, bottom line? Well, here's what we find. We find that mutual fund managers who are more predictable underperform their peers. So if I can predict, forget about 71%, 80%, 85% of your trades, you underperform. Whereas those that are harder to predict, those that are more innovative, those that have those trades that really seem to be things that we can't predict from their past behavior, they significantly outperform. Okay, they outperform their peers. And not only do they outperform their peers, but they outperform exactly on those trades that you can't predict. So in the context of that 71-29, turns out that the 29% of their trades that you can't predict, those are the trades that have the outperformance. And I think the interesting conversation we'll then have to have is, if we know that as a mutual fund manager universe and now as an investing universe, how can we incentivize managers to maybe spend more time on that 29%? Right? And what does this mean from the manager side in terms of the information they disclose? Because of course the whole reason we know this is that mutual fund managers' trades are disclosed. Their holdings are disclosed, essentially. And so that's where we're inferring this information. So what I'm going to do is just walk you through what this looks like in pictures, show you some of this performance, and then we're going to open it up to conversation. But look, that is this main result that I want you to have, and the main dynamics are what I've already said, which is just that there's a fair amount of this behavior that is predictable from past behaviors. And in labor markets in general, we don't pay for things that are easily replicable. Okay? If some new technology comes along that can easily replicate what you're doing for half the price, your wages go down. They should, right? Because I can get the same thing for half the price. That's the way markets work. And so if there is now a new technology that has changed the way we should think about what mutual fund manager trading and portfolio choice is, that should change the labor contract. That should change wages. That should change tenure. And it should change the incentives around that. And so that's what I think the really interesting point that we are now in this conversation is, and that's what I want your take on. And so let me just kind of frame this a little bit of a different way. If you could think about this in the context of other types of creators. So one big area which is now being contended because of this AI is in creative arts, right? So AI doesn't just train on these past books, past songs, past art, but it turns out that it can now produce it because of that. And what are artists saying? Well, artists are saying, hey, look, this isn't fair. You trained on all my past work. Imagine this. Imagine I were to take this and put this in the creative context. What if I told you you could predict 71% of the next Harry Potter? I'll tell you this. Look, if I could predict 71% of the next Harry Potter, I'd be writing Harry Potter 137. Because that thing is a moneymaker, right? Like, I would just keep doing it over and over. Now, what would J.K. Rowling say? Well, she should say, hey, look, that's not fair. When I wrote Harry Potter, I didn't know you were going to have this tool that could take my once I put it in the public domain, you could take it, learn from it, and then write my next Harry Potter book for me. It's not, I want some of those rents, right? Some of those rents should go to me. This is, the contract is ex post changing. And it's the same thing for artists. When I presented this paper at the University of Indiana, they had there, one of their crown jewels of the museum was $150 million Jackson Pollock. Okay, $150 million Jackson Pollock. I went into the museum, took a picture of it, fed it into Gemini, and said, okay, make me a Jackson Pollock. I then, during my seminar, on the screen, put $150 million Jackson Pollock and fake Professor Cohen Jackson Pollock, and I had them choose. And do you want to know which one the audience chose? It wasn't the $150 million one. Okay? It's amazing now what we can mimic and how that changes this contract. So you can think about that in the labor context. I would love your insights on that. What does that mean for mutual fund managers? If I was a manager, maybe I would then say, hey, look, this isn't fair anymore. I would go to the Securities and Exchange Commission in the US or the regulator and say, hey, look, I'm not going to disclose my holdings anymore. The game's changed. Because if you're going to now learn from my holdings, then pay me less, I'm not going to tell anyone. Right? That's the only fair way to respond in some game theoretic sense. Okay, let me just show you some pictures, and then we'll open this up. Okay? I'll jump straight to them. So how do we do this? Well, from a technical perspective, we use a recurrent neural network, so this long short-term model. They turn out to be especially good at remembering things even that happened a little bit further in the past and applying those into what the next behavior looks like. And let me show you some of these results. So here is this general result that I talked about. And so in the blue bars, what I'm plotting for you is the predictability, the prediction precision using our model, this simple AI model that just trains on the past 5 years of your behavior. And in the orange bars are this naive model. Okay, and the classic naive model that's used within these classification problems is just, you can think about a max indicator model. So it says, hey, look, if of those 3 behaviors, we have buy, sell, and hold here, if your most common behavior is a hold, I'm just going to assume you hold your stocks. If your most common behavior is buy, I'm going to assume you buy. So that can predict about 52% of trades, about 50, and our model predicts, again, that 71%. And so that 36% increase on the 52, that is a significant increase both economically and statistically here. Okay? This is pretty stable over time. Okay, so what I'm graphing here, this is just that 70%. This is what it looks like over the last 30 years. And you can see it looks pretty stable around that 70% over the whole time period. And the same thing for that 50% for the naive model. Okay? It turns out this is pretty stable also across all mutual fund categories. You might say, hey, Professor Cohen, is this, maybe all this predictability is concentrated in just certain styles of mutual fund management. So there's large cap, there's small cap, there's value, there's growth. Turns out it's pretty stable across all these. So you should think about the low and high there being between roughly like 69 and 75%. So across all these categories, it's about that 70% of trades we're able to predict in the next quarter based on the past behavior of these mutual fund managers. So when we turn to some of the variables that moderate this, this is where things get that kind of interesting. Okay? And so what types of funds is this especially easy to predict and especially hard to predict? Well, it turns out what makes it harder to predict are funds where the manager has skin in the game. So where manager ownership in the fund is higher, then potentially they have a higher incentive to be more innovative. And that's what we find in the data, that in those funds, they actually are more innovative and we have a harder time predicting their trades. Also, funds that get more inflows, as you get more inflows, it turns out they are more innovative and put those into more new places that the model can't predict. What kinds of funds are easier to predict? Well, funds that are closed. Funds that have some kind of restriction on you taking out money or in new money, they seem to be a little bit more comfortable with where they are, and they're easier to predict those templates. Also, managers that manage lots of funds, interestingly, so if you have one manager that manages 10 funds, it turns out we can learn a lot more about them, and potentially they're time constrained because they have to manage 10 funds instead of one, and so we can more easily learn what their template is. They're easier to predict within this data. Okay? So a lot of these go exactly in line with what you'd expect, what your intuition would be about these fund managers. And so the last thing I want to talk about before we open this up for a conversation is that performance. Okay? And so I'm going to show this to you in these graphs, and then we'll skip through the tables because I think this says it all. So what I'm showing you here is across these tables, this is 1 quarter, 2 quarter, 3 quarters, up to 1 year, 4 quarters after formation. And this is the performance across the different levels of predictability. Okay? So here you have the most predictable managers. It turns out underperform. And the least predictable managers, so those most innovative managers, outperform. And that's true across this time period. And you can see that as you get to 1 year, this is, and essentially across most of these horizons, it's monotonically true. which is to say it's not just coming from one extreme or the other, but across the entire distribution. As you get less predictable, that's where we see these outsized returns. Okay? And lastly, when we dig into the portfolio itself, it's exactly those 29% where we see the outperformance. So what we can do is we can actually then create an economy-wide portfolio, a stock market-wide portfolio to say, hey, look, we can say these are the stocks that are held and traded by those managers that are least predictable. These are the least predictable stock trades of the entire market. Maybe they were in Apple in this quarter, and the most predictable trades were in Intel. And we can actually then create a stock market-wide measure and portfolio to say, let's look at the most least predictably traded stocks and most predictably traded. And so even at the stock level, that causes this variation in returns. Okay? So it turns out those stocks that are least predicted and least predicted within their trading, they outperform by about 1% per quarter relative to these most predicted stocks. And that's, in a way, these are abnormal returns. These are alphas. These are things that none of our asset pricing models can predict. So they outperform in ways that our models don't understand. Okay, so it seems to be some kind of information that these managers have held that can't be understood and that seem to accrue over time. And in the same way, you can see in these charts, this is fairly monotonic over time. So these relationships that I'm talking about, these are pretty strong over that entire 30, 35-year time period. And so look, this is where we've gotten to, okay? We have established these results not only with the behavior of these managers, but also what it means for performance. And if you ask me what the most interesting part of this kind of exercise has been, and this project has been as we delve into it, is really thinking through what this means for the future of not only mutual fund managers, but also in general of workplaces, and in particular, because I'm a finance professor, within this financial landscape. And it all comes from this idea that we shouldn't compensate for things, and good labor markets don't compensate for things that can be easily mimicked, easily replicated at a low cost. And what does that mean, easily replicated at a low cost? That's not a static thing. What was easily replicated in 1999 is going to be very different. 2009, we should be able to replicate more things easier, right? It should become lower cost. 2019, again, it should move the bar up. We're now in 2025, and this new pattern recognition tool, AI, it's moved the bar up even more. So we can't be compensating like we did in 2009 if we're sitting in 2025 and we have this new tool. I think that's the really powerful and interesting conversation that I'm looking forward to having. I think this has applications, this idea, of course, beyond fund managers, but also other financial agents, financial analysts, research associates, CEOs, risk and compliance, consultancy services. All of these, it turns out, are humans. And like we said, humans, by construction, have very patterned behavior. We do things the same way over and over. And if those patterns can now be easily identified and then replicated, then that should change the way that we think about and compensate them as well. And so look, right as we wrote this paper, one of these LLMs, so this is Claude, they came out with a new product called Claude for Financial Services. And so the way that they pitched this product was that this was going to use all the data that we use in our papers, in our academic papers, so things like stock price data and holdings data and fixed income paper and even some data on private markets. And it was then going to create a comprehensive tool that could teach finance. Okay, it said, hey, we're going to teach how to do balance sheets and income statements and all these other things that we think about and we teach. And actually, unfortunately, this is exactly what I spend the first half of our core finance at HBS doing. And so when I saw that Claude had come out with this after we'd finished the first draft of the paper, my jaw dropped again and I said, oh my God, maybe Microsoft was right. Maybe finance and business school, post-secondary education, maybe we are in trouble. And in fact, this just came out this week, just 3 days ago. And so I wanted to add it to the slides. For the first time in recorded history, the bachelor's degree unemployment rate in the US ticked above associate's degree. And so here, this orange line is the unemployment rate of associate's degrees. These are 2-year degrees in the US. And what I want you to think about these associate's degrees are these are things like radiology tech, dental hygiene, HVAC, okay? So air conditioning and these types of jobs and advanced manufacturing, whereas bachelors are the usual things you think about. We'd send them to Goldman Sachs, we'll send them to Facebook, and we'll send them to these other, let's say, these more information-sensitive jobs. And for the first time over this roughly 30-year period, bachelor's degrees have a higher unemployment rate than these associate's degrees. Again, tying back to that first chart that we saw, that maybe there is something changing within labor markets. But I want to leave you with one other kind of frontier paper that just came out in AI, which I thought is very interesting and really needs to cap how far this can go. And that is this. It's a great paper that just came out called "The Cat Sat on the Blank." The cat sat on the blank. And what's the idea of the paper? Well, it's simply that AI models, by construction, they are pattern recognizers. So if I were to tell you the cat sat on the blank, complete that sentence, you might say the cat sat on the mat, the cat sat on the blanket, the cat sat on the chair. But you would never say the cat sat on the top of my hat, the cat sat on the purple, the cat sat on the I like cheese or something, right? You would never say something like that because it wouldn't make any sense. But it turns out that it wouldn't make any sense answer is exactly where innovation lies. So these AI models give a penalty for answering something that's off equilibrium, that doesn't fit what has been said in the past, and yet it's exactly what has not been said in the past where true innovation lies. So I'll give you the example with mRNA vaccines. So the way that vaccines had been done all the time up to then had been through chicken DNA. So when you used to go in for a vaccine, still today when you go in for a vaccine, they ask if you have an egg allergy. And the reason they ask that is because chicken DNA is the backbone of vaccination. It's close enough to human DNA, and so they would take part of the virus and part of the chicken DNA, and then they would mix them together, and it was a little bit of an art form, and it had taken us 4 years was the former fastest time when we developed one of these vaccines before the pandemic. This mRNA technology blew it out of the water. But the most interesting part when it comes to AI is that there is no version of AI or pattern recognition model that said, hey, add chicken DNA to a virus that would get you to mRNA technology, right? To actually changing the recipe of these viruses, forget about chickens, and we're going to do this in a whole new way. And so it's exactly that cat sat on the mat that would never get you there, right? It's because these AI models reward matching past patterns, they're never going to live in the space of innovation. And it's the space of innovation that really pushes forward every industry. Okay? And so with that, look, I want to thank you for the wonderful attention you've given, and again, for coming to be part of this conversation. And I really look forward to the questions that you have and the conversation that we're all going to have in the coming minutes. All right? Timothy, please.
Thank you, Professor Cohen, for your insightful lecture. May I please invite you to take a seat on the stage? We will now move to the discussion and Q&A segment, moderated by Mr. Tay. If you have any riveting questions for Professor Cohen, you may submit your questions via the QR code here.
You know, I feel really compelled, right, to keep my shirt on, right? So that's my one observation. My second observation, right, is that you just essentially wrote a paper that said that, you know, being predictable, if my actions can be predicted by a machine, then I shouldn't be paid. So I'm just wondering, right, maybe what I should do is just throw this on the floor, right, and just start a conversation with you. So let me start with a question, right? So if we ran an AI model on you as a husband, do you think, right, being predictable or being unpredictable generates more alpha in the relationship with your wife?
This I don't know if I want the mic to work on this
Well,
one,
this
but
is,
yes,
do
I think
remember, right? This is
Yes.
being live cast on Zoom, right?
that is true. Yes,
Yeah,
that's a great
but
point.
it is 8 o'clock, right?
Yes.
Yes, it is.
And so this I'm glad you asked this question, Timothy. And I not only have an answer, but I have an answer backed by science. Okay.
Let's hear what you have to say.
Okay. So here is what it says. So they've actually run these relationship satisfaction surveys, and what they found is this: that one of the biggest innovators. So some people, people have different preferences. The wonderful part about people, we have different beliefs, we have different preferences. Some people like to go out to dinner. Some people like to stay in. Some people like to travel. Some people like to, stay around where they live. But one significant predictor of relationship satisfaction and longevity, so people staying together, was actually innovations in the relationship. That you tried something new around whatever region that you both decided, yeah, we both have preferences for that. We both love going out. We both love staying in. We both love wearing pajamas. That trying something slightly new around that innovating was a strong predictor. So I guess my answer would be that, yes, if you were to take an AI model to Professor Cohen and get rid of the 71% of me that's predictable and take the 29%, the 29% innovative Professor Cohen would be a better Professor Cohen. He'd be a better husband, for sure.
Interesting, right? So you just gave the framework. So maybe I can give some context, right, that is within the scope of NTU on what you just said, right? So I remember back then, right, like a long time ago, I was dating this girl in NTU. So I used a predictable model of asking her for her accounting tutorials, right? Right. And after doing that for
That's the predictable model. That's the
That's
dating.
no, no, no,
That's still the dating model at NTU. Is accounting tutorials.
Okay.
That's impressive.
I mean, our students are really studious.
Yes, I'm impressed. I'm
what's
very
the
impressed.
easiest way to get close to someone you're interested in?
Accounting tutorials.
Accounting
obviously.
tutorials,
Come on,
right?
Yeah, makes
Okay.
total sense, yeah.
Well, here's where the unpredictability lies, right? So dating, right? So not together, but trying to get her interested. And after doing that for one semester, right, we found something consistent, right? For that semester, both the subject and me had straight C's for all my subjects. So think about that, right? It's perhaps, right? But the outcome is, fast forward, my daughter is in NTU right now, in another faculty, and the lady that I'm dating is, I married her and we've been married for 25 years. I don't have 6 kids, right? But I have 2, right? Right, and one is at NTU, right? So perhaps the innovation and getting straight C's really triggered something, right, in her mind as well. Okay, so this is a very interesting topic because it's got implications as for a practitioner in finance. It's got implications for academics, for students. It is applicable, right? So what you just told me is that as someone working in the banking industry, right, and who's managing money, that I'm going to get fired pretty soon, right? If I fall into the realm of the mediocre and I fall into the realm of the average, right? How do you think, right, that someone could take your research and how does it change the behavior of what's going on in the world of, managing money as well? What sort of insights do you think that you publish this paper? Obviously, you get feedback from both practitioners as well as the academia, right? What sort of response do you have?
Yeah, and so look, Timothy, I think that's a great question. I think it's asking the exact right question. And here's what I would say. I think there is a kind of glass half empty and glass half full way to view this. And so the glass half empty way, or maybe 71% empty way, is exactly what you're saying. Is, hey, look, now this thing's going to come along. It can mimic what I do. Like, I better start polishing my CV and working on my embalming skills, right? Because that's essentially the only place I have to go once I get fired from UBS or from other financial shop. Okay, and so here's the thing. I think the other way to view this, and how I believe, look, if there's one thing, you and I are both Chicago-trained economists, if there's one thing we believe in, right? Look, sun's going to come up tomorrow, okay? Taxes are going to come through, and markets work. I now get to 3 things, but we know that markets work, okay? We believe in markets, and I think the beauty of markets is going to work here too. And how do they work? Well, what happens is that this could free you, another way to look at this, from the 71% of what you do that is predictable. So you now come in, look, part of that is going to be things you didn't want to do anyway. And so we can take that 71%. We say, hey, look, Timothy, here's 71%. We know you're doing it. You know you're doing it. Forget about it. Don't worry about it. We're going to have this computer come in. They're going to do that so you can concentrate on the really innovative part of your job, on that part where it turns out you're adding the most value anyway. This is going to be a win-win for us. You get to concentrate on the cool stuff where you add value. We get to then pay you for that value and add more value. And in fact, it's going to help us to sort through our employees. Some of our employees aren't adding value. We'll quickly figure it out because their 29% is going to look pretty bad. Our 29% is going to look really good. And then, or yours will. And then we're going to get the right employees doing the right thing. We're going to have a happier, more productive workplace. And in fact, that's already what I see happening within early stage investing. So I'm working with this one firm. I'm writing a case on their early stage seed funder, essentially. And so what they've done is they've trained a model on seed investments. So they have this model that they've trained now on thousands, tens of thousands of seed investments. And they have done this. They've tried to take out the predictable things in what these seed investments have done. So when this entrepreneur comes to them with their new idea, they say, look, we don't want to hear about this. We don't want to hear about this. We know you're going to say this. So we want you to answer just this question. And so in that sense, it can increase the productivity of financial professionals. It can increase the productivity of the capital behind them so we can get money to the best ideas first. And so I think the positive view on this is that this is going to allow us to really have the cream rise to the top on every dimension, in terms of human capital, in terms of financial capital, and that's the way markets work better.
I think this is interesting, right? So as a practitioner and as a student of finance, basically learning finance is a codification of rules, how you price assets, and the fundamentals, the way you look at things has been taught to be the same. Finance textbooks are the same all throughout the world. But obviously, when you go into the institutional setup, right, you could say that the reason why there's predictability is because you get used to doing something and you think that this is the way that something works in a particular market, right? And the reality is that AI is able to predict the way that humans, work. But AI cannot predict how the markets work. What do you think about this particular statement? So basically, what I'm trying to say is that human behavior tends to move towards predictability. So if I was an endowment fund, I would tend to choose fund managers that are big, the set of rules that are there, and it leads to predictability and stability. But yet, right, you are saying that in order to search for true performance in funds, right, you have to look for something that's a little bit different. And that runs counter to intuition. And that has got implications for investors, family officers, endowments, and so on. How do you say to that? I mean, it's a long question, but the gist is that predictability versus unpredictability, the world looks for predictability, but you're saying that we should look for innovation through things that you can't predict.
Yes. Look, I love your predictability versus unpredictability framing, and I agree with it on the human side as well. And it would be like saying this is the way it has evolved. I'll give you another example. Airline pilots, right? So it turns out you want an airline pilot sitting at the front of the cockpit. However, there are parts of a trip, think of a long-haul flight, 12-hour flight, that are fairly predictable. Okay, that, hey, we know what wind speeds are, given that wind speeds are this, given that we know we can predict what's going to happen in terms of weather, we have that all there, that we're fairly sure not much is going to happen. And so on essentially all flights right now, they do have autopilot features that are essentially moving the plane forward within that path under predictable conditions. That said, you want the pilot there for when these shocks happen in markets, when COVID happens, when one of these big shocks happens geopolitically. And it turns out having the pilot there does help. Autopilot can screw up in ways that a pilot perhaps won't when they have experience, when they understand what to do when those happen. And so I think we're finding hints of exactly that, hey, these managers can be incredibly helpful in certain situations. Those situations are stock specific. They are state contingent, right? So when certain shocks happen to the model. And so I think using that mixing of, hey, this is what we can predict, and so we want it on autopilot, this part of the portfolio maybe even on autopilot, and this part for humans, I think that is and should be the new model that we think about here.
So the other thing I noticed about your paper was that you essentially ran the data through a efficient market, the US stock market, which is arguably the most efficient stock market in the world, right? What happens when you run this through in more efficient markets like the private equity market, the private credit markets, or like the fixed income markets, in which the microstructure is very, very different from where it is? Do you think the intuition behind what your findings are will still, to a large extent, hold true for some of these?
You know what? That's a great question. And so I would love to see this. As you said, it's harder to run it through in the sense that we don't have prices, but we do have the outcomes of deals in private markets. So it's something that I think is very much worth doing. And you could imagine it going both directions. So, you know what? I don't know which way it's going to go. You could imagine, hey, look, in the absence of prices and some of these other signals, what do these managers do more often? Well, I can tell you what they say they do, right? If you actually go in, they say, gosh, you know, I'm not sure whether I want to choose, you know, to invest in this new boba tea cafe chain, or I want to invest in this pizza company, or in this lumber shop, or in something else, but I'm going to go with my gut. You know, Timothy, I'm going to go with my gut. And so in that sense, that go with my gut, that could be very predictable. And it turns out you might be able to predict someone's gut very well, and that gut may actually come into more decisions in private equity or venture capital because I have fewer of the price signals, so I rely on something that's more predictable. But on the other hand, it could be what you're saying, in that they're so idiosyncratic that actually every decision is so odd that AI model can't learn anything because every one of your decisions really is that unpredictable.
So you're a student of both traditional empirical asset pricing, you know, Chicago School asset pricing, and you're also a student of behavioral finance as well. How do you reconcile these two? And we spoke about how did this particular topic, right? How did you get your start in doing research, right? In this particular area, you said something about looking at Edgar filings. Maybe talk us through some of your origins on how that began, right?
Yes, yeah, and so I'm happy to. And so you're exactly right. This melding of these two is something that I learned very early on, really at the beginning of my academic journey. And I learned this because when I was at Chicago, actually my main two advisors were this kind of yin and yang within both of these markets. Okay, so one of my advisors was this professor, Eugene Fama, who won the Nobel Prize for efficient markets. And what efficient markets is it's this idea that prices are right. And so Eugene Fama, he said, hey, look, prices, and now, you know, it's widely accepted, and like you said, especially in liquid markets, that price is the best predictor of the aggregate capital weighted view on what the discounted value of the cash flow should be. So like if prices of Tesla, let's say today, are at $300 a share, then, you know, if you think they should be 400 or 200, slow down a little bit. Because if they were supposed to be 400 or 200, we could make billions of dollars by pushing that to the right value. And so there are enough financial agents there that would do that like 300 really is our best guess of what prices should be. My other advisor was a professor named Richard Thaler, who also won the Nobel Prize a few years later for saying, yeah, you know that Fama guy in prices? Totally wrong. And the reason they're totally wrong is that we have these fields of psychology and sociology that show people make these really biased decisions and incorrect decisions, and they may impact financial markets too. And so what I've done over my career is to try to meld those two together, because prices really are just the aggregation of human behavior. And so I say, gosh, human behavior can sometimes push prices to the right value, get Tesla to 300, but there are some times when enough humans do the wonky thing that it can push prices of Tesla to 3,000. And so really what my research expertise has been, and what I've become one of the experts in, is trying to think about where prices deviate from fundamental value, why, and what caused them to converge back down.
I'm going to do something a little bit more interesting, right? I'm going to have a speed round. And after that, I'm going to open the floor to questions.
Okay.
Right. Okay, speed round. This is interesting.
What's
right?
Okay, how are we doing the speed? Is it going to be like Rorschach, the first thing that comes to my mind? Like ice cream?
Yes.
Protein?
Yes or no,
okay, yeah.
Or some short answer, or skip, right? You have the option, right? If it gets too sensitive, right? So, but this is, we're trying to squeeze as much out of you as possible, right?
Okay, all right, I'm ready for it.
So number one, right, which is the most beautiful business school campus you have been to in Asia?
Well, that's easy. Easy. NBS. Come on.
Right,
We're
right.
sitting in it, my man. We're
Right.
sitting in it, my man.
Okay.
I mean, look at this crowd out here. This handsome group. Come on.
Right. S&P 500, higher or lower at the end of the year?
Higher.
Right. Bond yields, higher or lower at the end of the year?
What is it? What's that?
Bond yields, treasury yields,
Higher or lower at the end of the year?
yeah,
I'm going to say lower.
lower. All right. Midterm elections, right, in the U.S.,
Yeah.
red or blue wave?
Blue wave.
Blue wave. Okay. Right. 2028, right, Republican or Democrat president?
I love this. Look, I'm happy to. Democrat.
Democrat. Who's going to win the Super Bowl in 2026?
Who's going to win the Super Bowl in 2026? Now, look, here's going to, sorry, I'm going to take over for the speed round. So I will say this. Here is an interesting behavioral fact, maybe the most interesting behavioral fact. This one, forget about the 71% I just told you, mimicking managers. If you're going to take one thing from tonight, it's this. It turns out that the research, and this is now across decades, across countries, has shown the following in terms of what is the most hereditable trait that we have. And so we think about, gosh, we have these really hereditable traits in terms of beliefs and preferences, okay? It turns out I can predict your political party, okay? Whatever country, and I can predict your political party at roughly 87% R-squared, about 87% of the time by your parents' political party, okay? But I can do better, okay? I can predict your religion at about 89% R-squared by, again, the religion of your parents, of your family. Totally cool. But something beats even that,
What?
okay? Something I can predict with 94% accuracy. And you know what that is? Your favorite football team. That's right.
Ooh.
So even your favorite football team is more sacred than religion or politics. So you know what, Timothy? I'm drawing the line there.
All right.
I'm not going to predict the Super Bowl.
It's fine.
I'll predict elections. I'll predict
Right.
anything, but
No,
not
it's
the Super
fine.
Bowl.
It's fine. And, you know, it's too sensitive, right?
Yeah.
Okay.
Yeah.
Okay. Question number 6, right?
Yeah.
More or less jobs created in the banking industry over the next 3 years?
More or less?
As in more jobs or job losses or job gains, right?
Okay. Can I view that as finance industry? Let me say
Finance industry, yeah,
Okay.
banking,
Finance.
finance.
More for sure.
More. Okay, more. All right. Good. Get that. All right. Would you prefer to invest in index funds or active long-only managers?
Index funds.
Index funds. Would you prefer to invest in public markets or private markets? Private equity, private credit, whatever, infrastructure.
Public markets.
Public markets, right? Do you think that AI can write the same kind of academic papers that you publish over your lifetime?
I'm going to clear my throat before this one. I'm going to look into the camera. Absolutely not. See, I have to do that. Save my job.
Yeah, right. The guys from Harvard are looking at this, right?
That's right.
Okay. Right. Okay, what's in your 401k right now?
What's in my 401k right now?
Yep.
I will tell you, and Fama is going to be smiling from on high. My advisor here. It is a broad-based world equity mutual fund.
Is it dimensional fund advisors? No?
Dimensional, that
Yeah,
would be
DFA,
even better.
right.
It would be
Yeah,
better.
okay,
They don't
sure.
offer that in my 401k, but yes,
okay.
it would be DFA. I like
that's
that.
a Chicago school, right? Okay.
This is fantastic.
Okay, last question, right? Really sensitive, right?
Okay.
Right. You can choose to skip it. Right. Would you come back again to MPS to deliver a lecture?
So, Timothy, I wouldn't come back because you know what?
What?
I'm not going anywhere, buddy. I'm not going to leave. There we go.
Okay.
Yeah. All right, perfect.
Please give
Thank you so much.
Prof. Cohen and I see questions, on my screen. Feel free, right? If you're online, send the questions through. But I like to open them. How many minutes do we have left? Right? Half an hour.
Half an hour.
Oh,
you know
man.
what? Would you mind if actually I open this a little bit differently?
Yeah, go ahead.
So, okay, given that I am a Harvard Business School professor, I actually want to start this off in a Harvard Business School style where I'm going to cold call. I'm not going to wait for the question to come to us. I'm going to cold call.
I see the
Okay.
really good looking Korean gentleman, right, right in front, right. It's right.
We're going to make it even tougher, okay? So I'm going to go to the back. So this is the theory of cold calling.
Yeah,
Is go to the
I'm
back of the
exempted from
room,
it, right? So please go
Okay.
ahead, right.
And you call on the person that's looking down the most, that clearly doesn't want to be called on. Okay, so we're going back. I think we're going to come right here. Okay, here's what I want you to do. I want you to tell me your name, and if you're a student, what year you are here. And then I want to know how you're using AI in your daily life.
Oh, it's my pleasure. My name is Olivia. I'm from China, and now I'm an MBI student. And mostly I use AI for study. Yeah. Because I'm not. No. I learned from the AI because there's a lot of articles I have to read, and sometimes I use AI to give me some conclusion, which I can really quickly to learn what it is about. And I'm not that good at English. For sometimes I use AI for translation. Yeah. Okay. Okay. Thank you.
So, I'm going to be a mic bearer, right? So you run the show up. My subjects are all sitting in the first row, right? Okay. We're going to deal with them later, right? Sure.
Okay. All right, we're going to do one more cold call.
Yep.
Okay,
Yep.
and then we're going to have a warm one. All right, we're going to go right to the middle here. Same question. Please.
My name is Henry. I'm alumni of MBS. So
Okay, what year? Come on, say year proud. Year proud.
2023 EMBA.
Very nice, very nice.
Yeah.
Any of your professors in this front row here? Any of you recognize them?
No.
Okay. Okay, all right. So tell us, how are you using AI?
I think for my work in supply chain and logistics, so I use AI basically to do some analysis. So sometimes also ask AI by certain issue in terms of supply chain and logistics. Also try to analyze inventory and also predict what could be the behavior from the customer or supplier based on some data from company of the patterns.
Okay, okay, those are great. All right, thanks very much. Proud MBS alumnus. I love. Okay.
So I get to do it one time?
Yes, yeah, please.
All right. This is burning question in my heart, right? Professor Huang, right?
Perfect call. The perfect call.
What is your most favorite Korean drama of all time, right?
Oh, that's a good one. That's
right.
a good one.
I have some predicted, top 10, right? Let's see if it's. I'm thinking about whether it's in the top 10 on my list as well. So I have my own predictive models as well, right?
I love it. Your AI,
this,
Professor Huang.
My wife and I, we actually do not watch Korean dramas.
Okay.
Yeah, we watch shows, but dramas, no. Sorry.
Right.
Okay, look, that could be a hallucination. Could be a hallucination.
Yes, right.
Yeah, that's completely fine. Okay, and so, look, here's what I want to do then. Let's move on. We'll move on to some of these questions. But I actually want to mention one other thing as we move on. And that is this. Here's my one interesting teaching and learning fact about AI. And so this study just came out. And so what it did is it split this room, right? A group of research subjects split this room into half. It asked a question. It said, okay, you have to answer this question and write an essay, give us the answer. You get to use AI. You get to use an LLM. Okay, and you can choose your favorite LLM, use that. The other half asked the same question, but it said, no, you can't use an LLM. You have to do it the old-fashioned way, through Google, right? You got to Google it, you got to click on things, then give us your answer. It collected all those answers, and then it actually, the research subjects come back 3 weeks later and talk about the study and what their answer was. And one side of the room gave significantly better answers and had much better recall. Okay, so learn the material better. Which side of the room do you think learned it better? The advanced LLM tool or the old-fashioned? Old-fashioned, 100% right. So the people that actually had to go and do and learn it themselves, they learn significantly better. And so this is one of these, I think, intoxicating parts of AI, but that can be really intoxicating in a way that hurts us in the long run, is that while AI seems like a very powerful tool that's going to help us learn more, it can sometimes paradoxically do the opposite. Okay? In that there is a benefit, there's a value in us actually then going and doing and learning and kind of struggling with those types of things. All right, Timothy, let's open up some questions.
Questions. So I have questions online and I have questions. Let's start with a question online, right?
Okay, perfect.
Right, okay, so... Right, will AI help build more interesting careers in finance? So basically it's a question about the evolution of finance with AI, right? And what does it mean for students at this point in their learning?
Yes, and so I would answer this question, and then Timothy, you should feel free to answer too, but I will answer. I think the answer to that question is an unequivocal yes. I think there's never been a more exciting time to enter finance than now. And the reason is that finance happens, and this has been true throughout its evolution, really going back now 5,000, go back to Hammurabi's code. Finance has been a consistent early adopter of innovation throughout time. Okay, you can go back to even internet. You can go back to these types of things like calculators, basic computers. And the reason is that there's a lot of money on the line. So finance does something that not a lot of other industries do. It takes levered bets on nearly everything. So in lots of industries, if you want to take a bet on something and you have $1, you can bet $1. In finance, you can take that $1, and we were just talking about it earlier, you can borrow another 100, and you can take a 100x bet on an idea. And that makes the stakes 100 times bigger. And so in places where the stakes are 100 times higher, you adopt pretty quickly or you die, right? That competition is really heightened. And so I think you're going to see finance as being early adopters of AI and creating a lot of new fascinating careers and a lot of new fascinating jobs and facets of careers that never existed before, that I think all of you in this room are going to both inhabit and innovate, and that will be a positive, I think, for all markets.
You do realize that we were in the same campus at around the same time, like 20 years ago? I wish I knew you and asked you for career advice, right, 25 years ago. So this question is interesting, right? So I love the airline industry analogy. If autopilot didn't remove pilots because accountability and judgment matters most in edgier cases, or I guess difficult cases, where do you think organizations are currently over-delegating to AIs in ways that could fail precisely when conditions become abnormal? So basically talking about, would you, have you tried Waymo?
Well, yeah, so yes, I have tried Waymo. And so I love this question. Whoever asked this question online, this is an amazing question. What I want to do is I want to take this question, cut it out, write it down on a piece of paper, cut it out, and put it in a time capsule. And this is going to be the perfect question to ask, I would say, 5 years from now. And the reason why it's the perfect question to ask 5 years from now is I just don't think we're there yet. So I was at this conference where they had a panel, it was on AI, and they had a panel of industry leaders throughout finance. And they asked them exactly this question. Okay, how are you applying AI at your firm? And so these places, think about the largest banks, largest consultancies within finance. They said, we are definitely applying AI. We give it to all of our, all of the assistants, all the research associates. We give them the coding tools. We give them all this. And I asked them, I said, look, that's great, but how is it changing what you do day by day? Like how, other than on your job post, you put, you need to be proficient in AI, and which is just like lip service. How's it changing what you do AI, and what you do day to day? And here's the answer. Here's the kind of inside view on this. Almost not at all. And each one of them said, well, it doesn't change what we do, but that's because what we do here at Oak Tree, you know, it's so specific and it's so important. You could never do that with an AI model. And then they said the same thing at Goldman and these other places. And so the truth of the matter is that there just aren't those places yet that are over-relying on it. Now, that said, I think there will be. And so I think you will get this autopilot effect, which that's a beautiful question. And maybe 5 years from now, we'll be like, oh my God, that blow up, it's definitely happening. Or in this part of the mortgage market, that's going to be like, that is the next big crisis.
Okay, we're going to open questions to the floor, right? So if you have a question, please raise your hand and give me like a long time to get to you, right? So, all right, we see a couple of hands. Yeah, thank you.
Oh, thank you very much, Lauren. It's always nice to be here. So now, just for the public, we know each other. I flew all the way from Cambodia just for you. So now,
Hey, that gets
Right,
around.
man, way to go.
well, I'm a chairman of our own business school anyway. So the question is because it got interesting because when you said if we know enough, 71 plus 29. So if we spend enough time researching on the 29%, which outperform everybody else, give it some time, and then more and more people do that. Don't you think that, in a way, if you do that long enough, if there are more people doing that long enough, that thing that used to be unpredictable, isn't that thing also becoming predictable somehow?
Yeah, and so Dr. Broom, I think this is a beautiful question, and I'm so glad you answered. And so I think you're hitting on exactly, really, one of the most beautiful parts of financial markets, and that's that they're living and breathing, and that they react and they respond to all new pieces of technology and information. So the boundary is constantly being pushed out. So I agree with you. Turns out, the second this paper comes out, that 29% is under attack. But then I would argue, then maybe that goes to a 25%. And then it will go to 20, and then people say, gosh, 20 is not enough. So they'll look at a different place to find a new 20 to 29 to 25 to 29. And so I think you'll see financial markets evolve in ways, and they'll have to evolve in ways or die to move to find new places where it can create this alpha, this outperformance. But yeah, I think you're predicting exactly what I think is going to happen within these financial markets. Perfect. Yeah, and the next question.
Yep.
Yeah. Good evening, professors. So I want to discuss on 2 points here. One is punishing because of being the 71%, and the rest 29%, like rewarding being the innovative one. Talking about the first part, like where you are punishing the 71%, but isn't it like how, like Timothy said, because I follow the financial model. That's the basic structure, basic base any fund manager would look at. I look at the company growth, I look at the quarterly result, I look at the balance sheet, I look at the cash flow, and that's so. I don't need, we don't need even to look at the funds. We can just go to the S&P 500, you do this analysis, you run this program, like what are the standard financial practices. Even then you can predict this set of stocks. And if any market is an efficient market, that's his natural ability to correct the prices, right? So there is nothing wrong in, like being part of 71%. Because those are the companies which are going to grow, who are going to get more business, more revenue in the future. So their price get adjusted to the next level. So that's the basic behavior, I would say. There's nothing to punish there. I mean,
yes, yeah. No, so I think, look, I think you put it beautifully, right? So let's take that 71%. So that 71%, I don't want to put into jail, okay? I don't want to punish the 71%, but we want to say this. We say, hey, look, if 71% of your portfolio is predictable, what that means is that I can easily replicate it, and so it should be compensated more like an ETF. Do I want exposure to ETFs? Yeah. I mean, I just told you my 401k is essentially all in ETFs. It's all in the 71%, okay? So far being from hating it, it's not in jail, right? It's at Professor Cohen's party. Like, I love that. But it's just, I don't want to pay Porsche prices for like an old Honda. So the idea is, hey, look, that 71% we do want exposure to. We just want to pay the right amount for that 71%. And then the 29% where you can outperform, we're going to pay you a different amount for that. So we're going to pay you for both, right? They'll come say, okay, look, and here's the cool part, right? Unlike the S&P 500, Timothy's going to have a different 71% than my 71%. So you may come and say, hey, look, I don't want Professor Cohen's 21%, I want Timothy's. And I'll say, that's great, but they're both easily replicable, so we only have to pay 10 basis points for both of those. And then maybe we even make them separable. Maybe you say, oh, I want Timothy's 71%, but I want Professor Cohen's 29%. And then you can do that. You can pay the 10 basis points for that, and then maybe that 29%, you have to pay 30 basis points or 40, because that is the more skilled part.
I mean, on the 29% also, my stand is like, I wouldn't call it as innovation. I would call it as randomness, because let's take an example. A couple of days back, Donald Trump has put a cap on credit card interest rate. So he has put a cap, 10% is the maximum credit interest rate you can charge on a credit card. So that might create it might create a fall in some stock, or it might create a raise in some other stock. So suppose if I'm a fund manager, by God's grace, I just have holding some other card company or something. So I might get benefited out of this news randomness, because of the randomness, not because that I have predicted this to happen. So there might be so many things. Like once Donald Trump is here, like because I'm discussing, because there's so many random events that happened in the last couple of years, like last 1-2 years. Being a tariff rate, no one expected Trump would go against the tariff in the last 2 years, and suddenly even Trump doesn't know how much is the tariff he is going to charge against any country. So that just because what I would try to say here is, out of 100 managers, 30 managers will randomly pick some stocks. Definitely they will have some diversity. So someone will get benefited due to some random news. What I would say is a good fund performer whom we should reward is someone who can outperform for the longer term. Because some fund manager can do better in 2 years because some news is in his favor. His randomness got correct.
Yeah, I'm just curious, right? Maybe can we ask what your background is? Is it engineering? Is it in finance? Or is it like, just really curious?
No, I'm an engineering background, and I'm pursuing Masters in FinTech with the SPMS school.
Perfect, perfect. And so look, I'm so glad you asked it and that you put it that way. I think it's a perfect way to say it. So what's so cool about this is that 29%, you're right, it might just be coming from total randomness. But here's the cool part, is that we with the financial tools we have, we can measure that. So we say, hey, look, let's see if that randomness actually generates performance that compensates for the randomness. Because it could be, hey, look, I'm taking on randomness, so I get a high return, but you're taking on so much risk. Buddy, you're just getting return for the risk, and I'm not getting anything extra. And so we actually have the ability to measure that. So everything that I'm reporting here, and I put on these financial risk models that say, hey, look, you're getting more performance per unit risk. So adjusting for that extra riskiness you think might be there, you're getting extra juice for that. And this is over 30 years. So again, going to your long term, over 30 years, this got you the highest risk-reward trade-off in the 29% versus the risk-reward in the others. Yeah, perfect. Yeah, thank you so much. Great questions.
Right, I think we have a hand at the... Right.
Hi, Dr. Hood. My name is Tristan. I'm a creative photographer. So I'd like to believe among everyone here, right, academia especially, they're all creative, right? And I believe that the AI itself is a non-creative agent. Yeah,
Okay.
We will all have data and we can research and everything, but we are always just following up to somebody. So I believe that I don't want to be that person to follow up to somebody. I want to be that person that's authority.
Perfect.
You know? Yeah, and you will never replace us. You know, especially when you are here today, right? I don't want the AI to come here and talk to me. I want someone that I cannot guess your mind. You know, if I were to photograph you now, you cannot imagine how I'm going to photograph you. Maybe naked, maybe with a Speedo, something that I will create when I want to create. And the AI can never predict my intelligence in the sense.
Oh, yeah, and so I love this. So I want to ask you a question. So name me one of your favorite photographers, or a few of them.
Favorite photographers?
Yeah.
Michael Kenner from UK.
Okay.
Yeah.
And so when you see one of his pictures, right, one of this is true with artists and photographers, right? Like if you get someone who really has a great eye, like you do, you can almost immediately tell it's one of his. Like you look at a collection, you're like, there's something about it. There's something about a Monet, a Picasso, right, a Pollock that you can tell. And so how are you now responding? And think about this. I would love your take when you say, hey, look, that same thing that allows me to tell a Pollock or a Monet or a Picasso that same strength that it had, which allowed me to gravitate toward it and for my heart to like really love and grab onto these, that's the same thing that makes it so susceptible to pattern recognition. And so to an AI producing an AI Jackson Pollock or an AI version of that picture.
Right.
And so how are you responding as an innovative creator?
Oh, by the time AI can follow me, I'm already one step ahead of time. So I like Michael Kenner now, but the next moment I like another person. But eventually I think I'm the best photographer in the world, so I like myself.
Yes.
The most. So I will never be satisfied being in this state, you know. If I mention I win an award 5 years ago, 10 years ago, I don't want to be known for that. I want to be known for constantly evolving, and I think that's what humans should do, to constantly evolve.
Okay, then you'll be in the 29%. You'll be the unpredictable. I like it, my friend.
Right,
That's
we have
perfect.
a question
Yes,
on the
perfect.
right
Thank
side.
you so much.
So thank you, Professor Cohen, for sharing with us. It's really eye-opening and mind-blowing what you've done with your colleagues. And my name is Man Yun. I am unemployed by choice. Basically, I'm retired. I was a NBS alumni.
Oh, nice. What year? What year? Give us the grade.
2009.
Very nice.
So I graduated 2009. We didn't have all these AI things. And I had a career in both sales and marketing and procurement. So I sat at both ends of the table in my whole career, working in an engineering company. So I just wanted to ask, but before that you asked about the application of AI. So I just wanted to share. I learned from a colleague of mine, because I'm retired for 2 years. So I asked him, I said, how do you use AI in your job? And he told me, whenever they have a procurement contract with a supplier, he feeds it into AI and asks where are the risk factors that he should negotiate on. I thought, wow, amazing. I should have had that in my career. I wouldn't have to pour through the details, right? And ask, beg legal to help me out. So that's one. The other application that a good friend of mine used was he had some chest pains. He did some, the usual ECGs and stuff. And he fed that data into AI and asked if he had a heart problem. And AI told him, you don't have, what you have could be this. And when he went to see the cardiologist, it said exactly what the AI told him. And I was just mind-blowing for me. So, okay, enough of that. So my question is really quite simple. You had shared that the model can predict 71% of the buy, hold, or sell decision.
Yeah.
So my question is, did the model also predict how much they would buy, sell, or hold, and when exactly they buy, sell, or hold?
Okay,
Thanks.
come on. You're like an AI model for predicting Professor Cohen's next move on the project. So look, that's a wonderful question. And so that's exactly where we're going next. So I love that you brought this up, because we figured we were going to start, look, when you're starting to ride a bike, right, you put training wheels on first. So we saw this as that. We said, hey, look, first we're just going to try to predict direction, and we're going to see how far we can get with direction. And then we were just shocked at how far we could get with direction. I think you're right. The next interesting frontier is to look at the magnitude of the buy, hold, and sell. And also we're just looking at the current portfolio, but I think it would also be fascinating to see, hey, look, what's their next purchase, right? So now they hold 100 stocks, but there's 4,900 others. Can we predict which stock they're going to buy next? And so I completely agree. I think that's the next fascinating thing to look at. And if we can break that, I think that has even more interesting implications, because it says, gosh, it predicts where within the sea you're going to fish and what you're going to pull up. Yeah, this is great. Thank you. And thank you for sharing how you're using it as well.
We're almost out of time, but I just have to do this, right? I just have to let Professor Huang have the last question. Right? This is, since you know Professor Cohen for 15 years, so what do you have the last? You can ask anything, right? Anything like, all right, real question, right? Not question about why his muscles are so big, right?
No, I know that already. We talked about it extensively yesterday. So let's suppose Matt and I were fund managers.
Yes.
And then a few of my traits are predictable, right? So based on your paper, you're saying that I'm going to do better than him, right? Now, is that because my unpredictable traits are so good, or is it because that my predictable traits are actually pretty decent, right? Or that his unpredictable traits are horrible? Like, which part is it? Because I think based on what it is, it has very different implications, right?
Yes, yeah. And so that's a great question. So what we find is that at the manager level, so when we looked at this, so what's causing the variation in the differences in your performance is that your 29%, your unpredictable trades are especially good. And so it's not coming from underperformance of the other side. The other 71%, you can think about this, it's not that relative underperformance of the 71%, but it really is the 29% versus the roughly 29%. So it's the unpredictable part. Now, I think what you bring up, which is a great question, Professor Wong, is that certainly isn't true for every manager. So there are certainly managers, let's say me, where my 21% is actually terrible, whereas yours is very good. And so looking at what drives mine to be terrible, yours to be good, when yours is good, I think that's fascinating to look at, and we'll definitely look at more.
Thank you, Professor Huang. Professor Huang is the epitome and the reason why you are studying at MBS and NTU. Great questions from our faculty and professor.
Absolutely.
Absolutely, right. Thank you so much. I think we come to the end of this. I just want to give all of us to give a great round of applause for Professor Cohen. It's been enriching, enlightening, as well as entertaining, right? You couldn't get someone better, to give a talk on a subject like this. So with that, right, we come to the conclusion. I pass the time over back to our MC.
Thank you so much, everybody, for all your really thoughtful questions, and a special thank you to the both of you for the really engaging and super fun session. Now, we would like to take a moment to express our appreciation with a token of appreciation presented by our Dean, Jun Yang. So could I invite Professor Cohen up to the middle of the stage first?
I'm going to say a little bit more than that. Just hold. So first of all, I really want to say thank you for the alumni, MBS alumni returning here. So this is the year we're celebrating MBS 30. We were renamed as Nanyang Business School in 1995. So we're going to have a whole series of activities inviting alumni to come back. And for now, the biggest event, the gala event, is determined as May 30th. Stay in tune. We're going to send more information to you. You will be more than welcome to come back. So this is the first thing. Welcome back. The second thing is actually I know Professor Cohen for 20 years, actually. I've cited his paper again from the social network one. I cite both Beyond's paper and Lawrence's paper, and to the point, he talked about opportunistic trading, whether it's routine trading. If you're an insider, every year you trade in February to sell your holding because you're a CEO, that's kind of a routine trading. But if 1 year you decide to sell in April, especially in the big quantum, that probably means you have some information, and sometimes you sell before perhaps the bad information is revealed. It's really innovative research. Almost all my papers cite that research. And then he moved to pattern troll, right? Study those people, try to use their information to take some advantage. And then now, before I knew which topic he would cover, I was trying to predict, right? I knew he was very innovative. So I think this is probably someone borderline 29% and 71%. I know this is going to be something really new. I think I guessed that category right. But I'm still very, very impressed. So you have been leading the profession, at least in my career of 20 years, all the time. You keep reinvent yourself and lead the research in multiple waves. So I hope that will be the next 20 years or even longer. Thank you again for coming here. We have a wonderful night of learning, discussing, and thank you for such a wonderful moderating. We have so much fun tonight, right? And for students and colleagues coming out from outside MBS, again, thank you for coming. So this is the first time we got many students outside MBS. I would like to invite you again for our subsequent seminars and public lectures. Thank you very much.
we invite Mr. Tay to receive the token of appreciation from Dean. May we now invite Dean to remain at the center of stage, Mr. Tay to stay at the center of stage as well. May I invite Mr. Huang, Mr. Cohen, Mr. Simba Chang to come up to the center of stage for a commemorative group photo. May we give all of them a round of applause? Thank you, professors, for the informative sharing and Q&A segment with very many valuable takeaways. Thank you everyone for sitting tight with us for the past few hours. And your energy has really been something that really pulled this entire series through. So without further ado, I would like to introduce you guys to our upcoming events. So if you really enjoyed today's session, do join us for the upcoming NBS ECGI PRI Public Lecture Series on Sustainable Business on the 10th of February. You may sign up via this QR code. To all our attendees, both in person and online, we hope you found today's session fruitful. Before you head off, we have one small request to complete a short survey using this QR code. It would really help us with the planning of future events. And with that, we conclude tonight's event. A big thank you to Professor Cohen, Mr. Tay, Dean, and everyone else who has made this event possible. Have a great evening ahead. Until next time, thank you.